everyone. Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Brian Rogers. If you've ever been dancing, you know that it takes two to tango, and that's the case with options trading. There's always a buyer and a seller. If you're relatively new to options, you may be familiar with the buy side of the trade. For example, an investor may buy a put option for the chance to sell an underlying stock or other asset at a favorable price. But there are many reasons why an investor might want to sell put options too. And that's what we're going to take a closer look at today with some help from an options trading pro. Joining us is Colin Watson, portfolio manager at Ninepoint Partners. Colin, it's great to have you with us. Thanks for taking the time.
Yeah, thanks for having me, Brian. Glad to be here.
Excellent, excellent. Well, just first off, I just wanted to know, can you tell us about the work you do at Ninepoint Partners and your professional experience trading options?
Yeah, sure, Brian. I work on cover call strategy known as the Ninepoint Energy Income Fund, and I also manage a cash secured put selling strategy known as the Target Income Fund that uses uh, this sort of strategy, put selling, to generate income. I spent just shy of 15 years working in derivatives at pension funds and alternative asset managers like Ninepoint.
All right. No, that sounds like some pretty complex stuff. But I know we're going to get in that. We'll simplify it a little bit for people today too. Is why do you feel options trading has become more popular with retail traders and investors in recent years?
I think that there's been a need for yield in a lot of portfolios, especially as investors get older and they looking for retirement and they want to find other non-traditional income sources. And so options provide you with another third income stream. Most people just use stocks and bonds to generate income, and options are a popular third tool that you can use.
All right. Well, before we get into our conversation, just a quick note to our viewers. We'll be sharing some of Colin's best practices when selling put options. However, they may not be broadly applicable to all options traders, depending on their needs and goals. So consider our discussion as food for thought. So if you'd like to learn more about options trading, check out our video lessons, master classes, and other webinars on the subject. And with that said, let's get into it. Let's lay a little groundwork for those who may not be familiar with options trading. There are two types of options: contracts, calls, and puts. I know we could go on forever and ever. We could probably do hour-long classes, but just in a nutshell or a summary, can you tell us or help our audience understand how do they work?
We'll start with a put option. A put option is a form of insurance that put buyers purchase to protect themselves against declines in the value of an asset. In this case, it'd be over a specified period of time and at a specified price, which, if we want to use options parlance, is known as the strike price. So essentially, a put seller is just in the business of selling protection to put buyers so that they can protect their portfolios. And also, we can think of a call as the exact opposite of that, right? Call buyers are looking to participate in upside and protect themselves against getting more upside in a particular asset. A call seller is willing to sell the insurance of upside to the call buyer.
Yeah, I like that explanation. I know a lot of times when we teach some of our classes, I always use the analogy, like call up, you can pick up your phone and you can call up your friend. So you're thinking call up, you're usually bullish. You're wanting that stock to go up and hopefully you can lock in that price, like you were saying, you're sort of that insurance that you're gonna lock in that price for the future. With a put, you can think of put down, you're gonna put down the phone. If you're buying puts, then you have that ability to put that stock or sell that stock to somebody at a favorable price. So it's pretty complicated for those that are brand new, but you can always remember, if you're looking to buy something at a favorable price, think of those calls, and like you said, those puts, which give you that kind of insurance as well. So that's a great explanation. Could you walk us through an example? Maybe that'll help the viewers. Could you walk us through an example of selling a put option, since that's what we're focusing on today?
Yeah, sure. So we'll use a simple example of, let's say, a stock that is trading at $60, and this also might explain why you might want to use put options or sell put options. Let's say the stock's trading at $60, and you think the stock might be not fairly valued, but you have an interest in purchasing the stock, but at a lower price. You might choose to sell a put at $50, and saying, "Hey, I'm willing to accept the obligation of owning this stock." At $50, and but anything above that, I'm not interested. I just want to collect my premium. essentially. So a put seller would sell a put option with a $50 strike price, and agree to take the obligation of and the risks of that stock at that $50 and below level. And in return for that, they receive a premium, which is an options premium, which they get to collect as income along the way.
Okay. So you're getting that obligation where you'd have to buy the stock and maybe at a cheaper price, but you're collecting or getting that income. Um, so that's one of the things that you mentioned there is, can you explain like, why might an investor want to sell a put option?
Using our prior example, an investor might want to sell a put option. So, at the current light price point, they're not maybe happy with the valuation of the equity, but at a lower price point, they might be interested in taking a position or adding to a position. So they can sell a put there and then essentially assist with their dollar cost averaging of kind of entering a stock at a lower level. Another reason might be that they want to create a strategy that collects income on a significantly large portion of stocks. So it might not be that you just do it on one, you might do it on 10 or 15 and create a portfolio that loan a bunch of stocks, but at a much lower price, right? That allows them to create a diversified income pool that is a little different than just owning equities unto themselves.
Okay, I know you mentioned earlier there's that obligation, and you said, maybe get it at a better price if it drops and things like that. I've heard when we're talking about puts or income and things like that, is there's a factor of volatility. Can you explain that a little bit? What does that mean in terms of, does that benefit you as an options trader with volatility?
Stocks with higher implied volatility will have higher options premiums, and that increases the yield on an option and increases the potential income stream that you can generate. Now, obviously, stocks with higher implied volatility or higher volatility in general also likely come with the higher risk of whatever strike price you've chosen potentially getting put to. So you have to be aware of the fact that higher volatility stocks are higher volatility stocks for a reason, and the premiums are higher potentially for a good reason.
So what are some of the potential risks involved with selling puts?
The stock might fall and might go below your strike price, and in that case, then you have to take delivery of the stock at expiration, or even before expiration if people want to deliver on it if it's an American style option. And essentially, you're taking full equity participation on the downside below that strike price. The other risk is that, let's say, you collect, let's use our example of the $60 stock, and you've sold the strike at $50. Let's say you collected $2 for selling that put, as an example, right at that $50 point. You know, the stock might rally to 65, right? All you get is the $2. So you have max upside participation on selling a put is just the premiums that you collect. And so there's a trade-off essentially from, having decided not to purchase the stock and instead decided to sell a put to generate the premiums and agree to purchase that stock, but at a lower price.
Which sort of market conditions are generally favorable for selling puts?
If the stock is range bound, even slightly up, right? Then in that environment, you're going to just collect your premiums and you don't have to take any risk of taking on ownership of the stock. And so that ends up being a very good trade-off versus, let's say, having just a single stock equity ownership, right? If the stock trades down a significant amount, then you know you can think of it as on a relative basis versus owning the equity. You'll have owned the stock and have exposure to the stock at a lower price point, so you'll probably be on a relative basis happier, right? But you will still, take the risk of losing money, right? If the stock, let's say, trades in our example down to $40 versus the $50 strike price, you're going to lose $8, and that's $10 into the strike price. Plus, you got the $2 of premium, so that offsets some of your downside risk. But you still are taking that risk of downside equity exposure, albeit at a lesser rate than the person who purchased the stock, who would have lost, in this case, $20, 60 to $40.
So we've talked a lot about selling put options, which is a strategy that may be new to some of our audience. So just a reminder as well that within TD Direct Investing, this is a strategy you would only be able to do in your margin account. So you would have to actually get an approval for a level 4 trading of options. So there are other accounts where you can have a lower level approval, But for selling option contracts, you would need this level 4. You'd have to apply for that. And you can only do this type of trade in your margin account. All right, now we understand the basics of put selling. Let's get into some of your personal best practices. The first is to stick to selling puts on stocks with high trading volume and open interest. Why is that?
One, there's going to be a more easily accessible options market. Two is if you're looking to do this on 10, 15 stocks, you can imagine that picking large caps means that you're not exposed to some small cap stock going down 50%. It's likely to be a kind of a lower risk affair, so to speak, or can be. You're really in the business of just trying to collect income if you're doing it from the perspective of an investor who just wants to do this on 10 or 15 names. Now, to be fair, if it's an equity that you want to own and you have a very, very targeted level that you want to own it at, then you have a broader universe of probably companies that you want to choose to look at. If you're doing this on a retail basis, the bid offer spreads and the liquidity of something that's on a smaller company or a more illiquid company are likely to be much wider. So you're likely to be collecting much higher exchange costs or friction in entering the options position. And so that's why I tend to also believe that if you're going to do this, for your portfolio, you're going to incur a lot lower costs if you're doing it on larger equities.
Well, yeah, that's a good best practice, I think, to implement for our audience for sure. Your next best practice is considering the beta of an underlying security before selling puts against it. How can this be helpful?
Beta is a very easily accessible metric to determine how much a stock might move if the equity market moves lower. Given that we're selling downside protection, we need to be very conscious of the fact that most stocks, when the market goes down, all stocks go down, right? And it can let you understand, okay, well, is this put that I'm selling 5 or 10% below on this stock that will typically move just exaggeratively 3 times as much as the market on a down move? Is that actually necessarily an attractive option? Is it actually a really unlikely event or a really likely event? So, it's an easily accessible piece of information to determine the level of sensitivity of a stock to movements in the market, and can help you calibrate what strike prices you might want to use when you're assessing is the premium worth it or not, frankly, for the put that you're looking to sell on.
Could you even give me an example as well? Like if we're looking at certain stocks within the S&P 500, do you find is there a typical beta you're looking for? And can you give us a little bit of an example? How would you apply that?
Yeah, I think a simple example of this might be the Russell, right, 2000, which is a smaller cap index, tends to have a higher sensitivity or a higher beta to movements in just the general equity market. So an investor who might be looking, let's say, at a put option and is worried about a 10% decline in equities in general, right? They might look at a put option that is, let's assume the beta is 1.5 on the Russell versus the S&P. They might be looking at an option that's 10% out the money and it's trading at a large premium versus the S&P. But in reality, given that it's a higher risk affair, given the beta is higher in that scenario where you think the market's going to go down 10%, it might not be as attractive as an option on a risk adjusted basis as you might think.
And I think I've heard you say before too, you might want to give yourself a little bit more of a margin of safety. If you're writing those puts, you might go a little bit lower in a strike price just to avoid if you don't potentially want to get assigned to buy that stock, right away, or if there's a big move in the market. But you're also going to want to look for getting rewarded with a certain premium. Does that make sense?
Yeah, I think your idea that you need to just calibrate that probably a higher beta stock has higher risk of getting assigned, and you need maybe a bit more of a margin of safety in the strike price that you want to choose. Unless frankly you want to own it at that level, then it's you're comfortable doing it, then that's fine.
All right. And on a similar note, do you have a rule of thumb when it comes to choosing the time to expiration when selling a put?
Generally, I prefer to sell shorter dated put options on underlying securities. With higher volatility, I mean, we've used the term beta quite a few times, but beta and volatility, they tend to be related. But with higher volatility, given there's a greater chance of an unfavorable move with higher volatility stocks before expiration occurs, potentially.
All right. Well, thanks for explaining the importance of open interest and volatility and beta, Colin. Now I wanted to take a moment to dive into WebBroker to show our viewers where they can find this information when selling a put option. So let's take a dive into WebBroker and look at some of the measures that Colin had mentioned in this webinar today, such as beta, volatility, and open interest that are related to selling your put options. So if we go to the very top of WebBroker, you can see we can enter in a symbol. I've got Amazon opened up already. And if I scroll down about halfway, I can see the measure beta is on the first screen. So if we're on the overview tab, I'm going to scroll about halfway down and you'll see beta. So you can find that. Usually it's close to one, a little bit higher or a little bit lower than one. And then we're going to jump into the options tab to find the other. So if we click on options right here, we're looking for open interest, which is usually an indication of liquidity on an option. So that's the amount of options contracts that are still outstanding on that particular option. It usually goes hand in hand with volume as well. Most of you will be familiar with volume, where that's the number of options traded in the day, just like a stock would be the number of stock shares traded in a day. So they're normally going to be side by side. You can see if I'm on this options tab right here, right now, I can scroll down and I can see there's my expiry. There's the current series of options I'm looking at, the September 22nd, for example, or whatever date we are happen to be looking at along this top column. And then you can scroll down and you can see within volume and open interest, the numbers are going to start to change as it gets closer to where the stock is trading in the market. So if we follow these two columns down, we're looking at the calls on the left and the puts on the right. We can see that we have open interest on this column just to the left of the strike prices right here. And as I keep scrolling down, the headers disappear for a moment, but we can know that's these two columns right here. We can see there's 3,000 contracts for that particular call option. If I'm looking at the $139 strike, 3,000 roughly have open interest, meaning those are the actual options that are still open. And there's about 6,000 contracts traded today. So that's giving you an idea of a little bit of liquidity within the option. And you're normally going to see within the bid ask, they're very close together. So there's not a large spread between these two numbers, which puts you in a situation where if you were selling an option, you may have to buy it back at a much higher price if there was a larger spread, or vice versa, if you were buying an option and you needed to sell it. You don't want to see a large spread. So if there is quite a bit of liquidity on these options, you're going to notice that within this open interest, these columns here. If I scroll up a little bit further, the two columns on the just to the left of the strike price for calls, and they're the two columns on the far right for puts. So that being said, in addition to that, you can also find implied and historical volatility under the analytics tab in WebBroker. So I'm going to click on analytics. This is within the option chain. So if I click on this plus sign, now I'm going to see a bunch of measures, some other things we didn't talk about today, but I'm going to see the Greeks, which are these delta, gamma, theta, etc. That's some other information you may want to consider if you are trading put options. But what Colin had also mentioned was implied volatility right here, which is this column here about looks like it's the fifth one from the left. So you can see implied volatility that I've highlighted. And you can see up at the top, it is a little bit limited in terms of how much data it gives you for historical volatility, but there's a measure of an average, roughly around 20-day historical volatility that you can now compare. That's what's happened in the past with the stock in terms of volatility. And implied volatility is what the market is expecting. So you can see if we scroll down in this column here under implied volatility, I can see that for Amazon, which is the stock we're looking at now, as we get closer to this green line, which is the current stock price, you can see it's roughly around 28 to 29 approximately. It goes up to 30 in some cases, depending on the strike price. So we can scroll to the top and we can see that expected volatility is a little bit lower than what it's even been in the past, roughly around that 20-day average around 38. So as Colin was saying, that could be an indication of, you might consider, is the premium going to be a bit higher if the volatility, the implied volatility is higher? If it's a little bit lower, you might be expecting you're going to get a bit of a lower premium. So that could be a consideration for put sellers as well. So how might an investor get a sense of how much a stock might move to help them set an appropriate strike price?
A really easily accessible tool that definitely helps get the job done, that most people have access to in base technical analysis, is Bollinger Bands. And, effectively, if you think about what a Bollinger Band is it's a deviation from a moving average, which is essentially a trend. And the size of the band is effectively a function of the volatility of the stock. And so it's essentially telling you, hey, is this based off the volatility of the stock? Was this a big move or a small move, right? Based off historical volatility and the trend of the equity, what are reasonable looking levels? And obviously, on a go forward basis, we never know, but it's a good starting point. Using Bollinger Bands can be a really effective way to get at a level that might have a lower probability of being assigned in an option.
All right, yeah, and I know we're introducing another thing that if there's newer investors, this is technical analysis. But as you said, it's something that's fairly readily available, and there is some education in our web broker platform as well if you want to understand some of these technical analysis tools. But if you already have an idea of how they work, we can take another deep dive back into WebBroker to show our audience how to apply and interpret Bollinger Bands on a security. So in order to add any studies or indicators to a chart in WebBroker, you have to use some of the menus that are along the top. So right now I'm in WebBroker looking at a particular stock. I'm looking at Apple, and I click on the charts tab and I can see the chart here. I can see that it's a 1 year, 1 day chart. And I can see across the top, there's chart style, upper indicators, lower indicators. To add a Bollinger Band, that's an upper indicator. So meaning that it's inside of the chart. I'm going to click the drop down here and I'm going to select Bollinger Band. It's actually the first one you can select. So that's going to add that on. And it's basically a Bollinger Band is giving you typically 2 standard deviations away from the simple moving average. It's creating this band, which can help indicate when there's overbought or oversold movements. I'll show you a little bit more on that as we go along. But one of the things you really should complement Bollinger Bands with is the RSI, which is a lower indicator, and you can add over here at the very bottom. So if I continue to scroll down, there's relative strength index, or RSI is what the short abbreviation is for. And that's going to put in a lower indicator to give you some further indication of whether the stock is kind of looking like it's overbought or oversold, which either may indicate that it's going to continue a trend or reverse a particular trend. So what I want to do is jump into advanced dashboard to show you a little bit more detail and a little bit more robust chart that you'll have that's on a streaming basis normally as well. And you can see it, I think, much better than you can in WebBroker. But you can use either or. That's how you would add it into the WebBroker platform. If we jump over to Advanced Dashboard, so those of you who've already used it or if you're just getting introduced to it now, you can launch Advanced Dashboard from WebBroker. And it's going to look like this. So it's a trading view chart suite that you get within Advanced Dashboard included. And in order to add the indicators, I've already added them on here. But if I were to take them off, I can actually just click the X and I'm going to remove RSI and Bollinger Bands, and I'm going to add them back on. I'm going to click on the indicator, and I can see it's down here at the bottom for Bollinger Bands. So that's going to add that in. And then I'm going to type in relative for relative strength index. There it is right there. And that's going to add that back into the bottom as well. But typically the way it's used is you're looking to see if there's a point where the actual chart or the price goes well above the upper band or well below the lower band. You can actually use the RSI down here at the bottom and see if it supports that particular conclusion that there's either going to be a reversal or a continuation of the trend. So you can see here if it broke out above the upper line, we can see that it's well above this. There's a 70 and 30 point that they're looking at RSI. It's a measure at 70 and 30. If it's outside of that RSI band, well above 70 or well below the 30, then it could indicate that there's going to be a reversal of the trend. I almost think of it as if you're going above 70 and you're getting to 80, 90, etc. It's getting a little too hot to hang around. If you're on, say, like you think of the band as like a river, it's getting too hot, it's too inhospitable. You're going to say, okay, I'm going to get out of here. I got to go back to the river. May not happen right away. Usually it could happen over a couple of periods as well. Then you're going to notice that it does do a reversal. And then that could happen again if we see this. But that is one way you can use Bollinger Bands, or the way it does indicate trends. And if you want to learn more, you actually can go into WebBroker. You can go into the Technicals tab. And on the right-hand side, you're going to notice there's a little, it looks like a graduation cap for education. If I click that and I go to oscillators under Bollinger Bands, and then I'm going to read through and I can see there's bullish and bearish indicators. It actually shows me trading considerations. And then this actually describes exactly what I was just talking about. When the price touches or penetrates the upper Bollinger Band and the RSI is above 70 or below 30, then it'll give you the idea of where there could be a potential move. All right, so the third best practice we'll cover is taking profit by closing a trade ahead of expiration. Investors may be leaving some profit potential on the table by doing this. So, why do you feel this can be a savvy decision?
In my experience, investors are generally not very adept at managing very short term moves in stocks, and that would apply to options positions as well. So I tend to find when puts are pretty close to the money and they have maybe a couple days to expiration, I'm more willing and more flexible to exit that position before expiry, even if there might be a moderate amount of income that I'm going to be earning in a relatively quick period of time, in just a few days.
Right, right. So, what's your rule of thumb to help you decide when to close a put option and take the profit? Do you have like a rule of thumb, any numbers you can kind of throw out that you might use?
Yeah, I might exit an options position, when I capture the bulk of the premium, let's say 70% near the expiration window. And what I mean expiration window within, the week before expiry. And the underlying stock is 1 to 2% move away from the strike price. And that's especially true if I don't want to take delivery of the position. This becomes more true as the stocks become more volatile, as you'd imagine, because there's a higher risk that I can get called away or get put to with even more volatile stocks.
All right. Well, I'll put you on the spot a little bit. I think it helps drive it home much better for our audience as well. And even for myself too, I learned this way too. So I think a lot of people are similar and learning with examples. Could you give us an example? I know we've kind of had an example going through. Maybe we can use that of if you're using that 70%, that 1 to 2%, how would that look in terms of numbers related to selling a put option?
Yeah, sure. Let's use our prior example where we had a stock at $60. We sold a put with a strike price of $50, and we collected $2 in premiums. Let's say that we're getting within a few days of the expiry window, and the stock is 51 and a half bucks or 51 bucks, right? Very close to the strike price of the put. And let's say we only have 20 to 30 cents of premium left in that position. If you think of it, 30 cents in a couple of days, that sounds pretty great, right? On our initial position. But if I decide that I'm less inclined or desirous to take ownership of the position at that strike price, then I'm more inclined to want to exit that position early and just forego the 30 cents of premium. And perhaps not take the risk of losing the rest of my premiums, frankly, if the stock has a violent move lower and I don't get to collect any of the $2.
And on a related note, how do you get a sense of what a reasonable premium might be when selling puts?
I tend to consider the historical premiums of a specific moneyness of an option on an underlying equity or an index relative to its history. So, let's say, what is the historical premium that I've collected for 90% out the money puts on this particular stock over time to get a sense of is it high or is it low? Another way to look at it is to look at whether or not the implied volatility on the option that you're looking at is above the realized volatility to see if you're earning a premium over kind of historically what the volatility has been for this equity. And a third one to consider is that, higher beta and higher volatility stocks generally require higher premiums, given that there's, more heightened risk of unfavorable price swings, that could lead to the option being assigned.
All right, and I like that you said the idea of implied volatility versus realized volatility. Sometimes you hear the term historical, which I think is the same thing, historical volatility versus implied volatility. So you can look as a seller of options and see, is that implied volatility a lot higher? Oftentimes brokers will provide a graph, like a graphic view, and if you can see that that's a lot higher than normal, if there's some type of event like earnings or another type of news event or something that's indicating there could be a higher level of price movement. That may result in more premium for those sellers, but you got to be careful too. There could be more risk involved as well. Okay, so the last best practice on your list is to consider any dividends an underlying stock may pay when choosing a strike price. Why might this be important?
Investors might want to consider the if a stock is going ex dividend in the prior to the expiry of the option. The reason for this is because stocks will tend to adjust down by the amount of the dividend when the stock goes ex dividend. And so, in fact, you might be thinking, hey, I'm selling this stock with, let's use our example, at a $50 strike price, but the stock's about to pay a $5 dividend. Then you think you've really offered yourself a lot of margin of safety between that 60 to $50. But in reality, the stock's going to go ex dividend and it's going to fall by, as we said, $5, and therefore that strike price on that put is actually a lot closer than you think. And so for really high dividend paying stocks, this becomes a little bit more important. And stocks with 1% to 2%, it's less relevant. But higher dividend paying stocks, that can actually materially impact maybe the level you think you're selling a put's downside at, given that the stock will likely adjust down at least by the amount of the dividend when the stock goes ex dividend.
All right. So another thing on the checklist when selling puts is to look at that dividend, find out what that dividend is, and see if you can find that ex-dividend date as well. All right. So thanks for sharing some of your best practices when selling put options, Colin. We're going to have to leave our conversation there. Any final thoughts you'd like to share with our viewers?
Yeah, sure, Brian. Income portfolios, they tend to rely really heavily on just stocks and bonds to generate the income they need through dividends and coupons. And, an investor can access a third income stream, through options, selling calls or selling puts that can be added to the portfolio.
Well, thanks again for joining us. And for those in our audience, make sure to register for our upcoming live webinars and check out our library of on demand content available in the Learning Center and on our YouTube page. See you all next time.